Private equity is one of the most powerful investment vehicles ever created, but most people don't understand how the money actually flows. How does a PE firm raise capital? How are funds structured? Who gets paid what, and when? In this video, we break down the anatomy of a private equity fund from the ground up. A private equity fund is a pooled investment vehicle, meaning multiple investors contribute capital that a PE firm deploys into acquisitions. The fund has a fixed life, typically 10 years, with the first 5 years focused on investing and the back 5 on managing and exiting portfolio companies. The two main parties in any PE fund structure are the general partner and the limited partners. Understanding their roles, rights, and economics is the foundation of everything in private equity. The general partner, or GP, is the PE firm itself. Firms like KKR, Blackstone, Carlyle, or Apollo serve as the GP. The GP manages all investment decisions, operates portfolio companies, and handles the day-to-day of the fund. The GP is the decision-maker and bears unlimited liability. Limited partners, or LPs, are the investors in the fund. They provide the capital but play a passive role. They cannot participate in investment decisions. Common LPs include pension funds, sovereign wealth funds, university endowments, insurance companies, family offices, and high-net-worth individuals. Why do LPs invest in PE? Because private equity has historically delivered returns 3 to 5 percentage points above public markets over a full market cycle. For a large pension fund managing hundreds of billions of dollars, that outperformance compounded over decades is transformative. The legal structure of a PE fund is typically a Delaware limited partnership or a Cayman Island structure for international investors. The LP agreement, the fund's governing document, defines everything: contribution requirements, distribution waterfalls, management fees, carried interest, and LP rights. Capital commitments are how the fund works. LPs don't send all their money to the GP on day one. Instead, they commit a certain amount, say $100 million, to be called over the investment period. When the GP identifies a deal, they issue a capital call, and LPs must wire funds within a short window, often 10 business days. The investment period is typically the first 3 to 5 years of the fund's life. During this time, the GP identifies, underwrites, and closes acquisitions. After the investment period closes, the fund can no longer make new investments, it can only manage existing ones and make follow-on investments. Fund size matters enormously. A small PE firm might raise a $500 million fund. A mid-market firm might raise $1 to $5 billion. Mega funds like Blackstone raise $25 billion or more in a single fund. Fund size determines the size of companies you can target. You generally invest 1 to 5 times your equity check per deal. Management fees are the GP's primary income stream before any investments are realized. The standard is 2% of committed capital per year during the investment period, shifting to 2% of invested capital after. For a $1 billion fund, that's $20 million per year, enough to pay staff, rent, and overhead. After the investment period, management fees often step down to 1.5% or lower, because the GP is no longer actively deploying capital. LPs negotiate these terms aggressively, as management fees directly reduce their net returns over the fund's life. Portfolio companies in a PE fund are owned through a holding company structure. When a PE firm acquires a company in an LBO, they create a new entity, called the NewCo or HoldCo, that sits on top of the operating company. This structure allows the PE firm to control governance, appoint the board, and manage exits cleanly. The PE firm typically assigns a deal team to each portfolio company. This team monitors performance, works with management on strategic initiatives, and prepares the company for exit. Senior partners serve on the board. Analysts and associates build financial models and track KPIs. Value creation during the hold period follows 3 main levers: multiple expansion, selling for a higher multiple than you bought, debt paydown, reducing leverage so equity captures more value, and operational improvement, growing EBITDA through revenue growth or margin enhancement. Operating partners are a critical and growing part of the modern PE firm. These are seasoned executives, former CEOs, CFOs, or division presidents, who embed with portfolio companies to drive operational change. They are not financial engineers, they are operators who know how to run businesses. As portfolio companies are sold, through trade sales, secondary buyouts, or IPOs, the proceeds flow back to the fund and are distributed to LPs and the GP. The distribution waterfall determines the order in which these proceeds are split. The standard waterfall works as follows. First, LPs receive return of capital, all their invested money back. Second, LPs receive a preferred return, typically 8% per year, on their capital, called the hurdle rate. Third, the GP receives a catch-up, usually 80 to 100% of distributions until they've received their carried interest share. Fourth, all remaining profits are split 80/20ths between LPs and the GP. Carried interest, the GP's 20% share of profits above the hurdle rate, is the engine of GP wealth creation. On a $1 billion fund that returns $2 billion, the profit is $1 billion. After the 8% preferred return to LPs, the GP might earn $180 to $200 million in carry. Split among a handful of senior partners, this is life-changing money. Carried interest has been politically controversial because it's taxed as long-term capital gain, at 20%, rather than as ordinary income, which can be taxed at rates up to 37%. Critics argue this is a tax break for wealthy fund managers. The debate has been ongoing for decades in Washington. Clawback provisions protect LPs in case the GP earns carry early but later investments perform poorly. If the fund ultimately underperforms the hurdle rate overall, the GP must return previously paid carry to LPs. This aligns long-term incentives and prevents GPs from distributing profits prematurely. Co-investments are a powerful tool for large LPs. When a PE firm does a deal that's too large for one fund, it invites select LPs to invest directly alongside the fund at little or no additional fee. LPs love co-investments because they get PE exposure with lower costs and more control over specific deals. Fund of funds are intermediaries that raise capital from smaller investors and invest in multiple PE funds. They provide diversification across managers and vintages, but add an extra layer of fees, typically 1% management fee and 10% carry on top of the underlying fund fees. The secondaries market allows LPs to sell their fund interests before the fund's natural end of life. A pension fund that needs liquidity can sell its PE fund stake to a secondary buyer. The secondary market has grown to over $100 billion annually and provides important liquidity to the otherwise illiquid PE asset class. GP-led secondary transactions have become increasingly common. Instead of selling a company in a traditional exit, the GP creates a continuation vehicle, a new fund that acquires the company from the original fund. This allows GPs to hold their best assets longer while giving original LPs the option to cash out. Evergreen funds are a newer structure that doesn't have a fixed 10-year life. They allow continuous capital raising and deployment, providing more flexibility. They're growing in popularity among retail-oriented PE platforms that want to offer PE access to individual investors. Vintage year matters enormously in PE. Funds raised right before a market peak, like 2006 to 2007, often underperformed because they bought at high prices just before the financial crisis. Funds raised during or after a downturn, like 2009 or 2020, often outperform because they acquire assets cheaply. The PE fund structure creates powerful alignment of interests when designed correctly. GPs have their own money in the fund, typically 1 to 3% of the total fund size, ensuring skin in the game. Carry keeps GPs focused on long-term returns. Hurdle rates ensure LPs are rewarded before the GP profits. As the PE industry has matured, LPs have become increasingly sophisticated. They negotiate fee discounts, co-investment rights, transparency requirements, and governance rights. The power dynamic has shifted somewhat from GP to LP, especially for megafunds where LP capital is abundant. Private equity fund structure is a masterpiece of financial engineering, designed to align incentives, manage risk, and generate returns for all parties. Understanding this structure is not just academic. Whether you're investing in PE, working at a PE firm, or managing a company owned by PE, this is the framework that governs everything.